Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Hi, my name is Ben. I'm a popular investor on eToro. Today, I'm talking about a position that is in the managed fund, the fund that I manage on eToro, Crassus Investments, and it is the very, very interesting and somewhat controversial Glencore. Okay, so the commodity conglomerate, fascinating company with a fascinating history. I'm going to talk about that. And the question is, how does it look as an investment? How does it stand up to our investment thesis? Thanks for watching. If you haven't already liked and subscribed, I would greatly appreciate you doing that to the YouTube channel. And let's begin. So how does Glencore as a company stack up against our Crassus investment formula? So we're looking for companies with low debt, with a margin of safety, that have a history of sales growth or that have a predicted sales growth moving into the future, strong margins, free cash flow growth, my personal favorite, and ideally a history of share buybacks. If we get those, we want to take a good look at the company and decide at what price we can create a great return from what should be a good company if it passes those criteria. So some quick facts, quantitatively, revenue expected to come in 211 billion. Okay, so it's grown at about 5.5 CAGR, excluding 2020, which was an anomaly over the last 5 years. EBITDA 13.8 billion, 6% CAGR is quite good, decent margins. Market cap 64 billion, enterprise value 92.6 billion. I'm talking in US dollars, but I'm talking about the London Stock Exchange listing, which will obviously be quoted in pounds sterling. So the reason is I found it a lot easier just to simply convert it over to US dollars with the software that I use, and so everything will be in US dollars henceforth. Price is in US dollars $4.88 at time of recording. 13 billion shares on issue, 131 million in buybacks last year, so not a huge amount, but not bad either. Return on capital about 5% over the last 12 months, and net debt to EBITDA at 2.6 times. So price action over the last year, okay, so steadily creeping up, 55% up on the last 12 months. Obviously, the base effect of that will be quite low when you take into account the broad market sell-off thanks to COVID. So it's recovered nicely, and I think it's a company that's in a position to do very, very well in the future. So Glencore, okay, originally started out as Mark Rich, or Mark Reich was his name. Fascinating story. Mark Rich & Co. Was a survivor of the Holocaust, moved to New York. It was just an absolute hustler and built Mark Rich & Co. from the ground up into the largest commodity trading house and business in the world. Read the book The World for Sale. It's a fabulous book and goes into the story of the origins of Glencore, not only Glencore but also Vitol and a couple of other huge commodity houses around the world. And it's just a fabulous insight into the economy and geopolitical nature of commodities and how essential they are to our way of life, and basically everything we owe in terms of our development in GDP and quality of life and infrastructure, etc. over the last, call it a century, has been largely due to commodities. And so whoever controls the commodity flow controls the way the world runs. Glencore is a vertically integrated business. So and if you read the story, you'll read about how they branched out from not just being a purely I guess a problem solver of being able to get oil to certain dodgy places around the world, such as apartheid, South Africa, and so on and so forth. But they started to own their own mines, so they could buy out mines if the financing went badly. And so now they have a number of mines throughout the world, particularly coal mines. And for me, that is extremely interesting. They've made some fabulous acquisitions of coal mines moving into the future. If you think that coal is going away, I've got news for you. There are over 1 billion Indians and Chinese that are rising up the ranks of the middle class, and they will need and want energy provided in its cheapest and most efficient source that's available to them. And so coal-fired plants are not going anywhere anytime soon in the developing world. And if you look at the rise of sub-Saharan Africa, as those demographics would project out over to the next century, there's still going to be a place for coal. Anyway, it's far from just coal that this business owns. They're a trading business, so they own commodities outright. They supply commodities to various regimes around the world. They clip the ticket, okay, so they take a percentage of the movement of commodities throughout the world. They, as I just mentioned, they own certain mines outright, so they own from the A to Z, from the ground up all the way through to the end consumer. They have royalty deals in which, for example, an up-and-coming African country might need finance and funding to build their mine. They may have the natural resources, but they don't have the finance and the ability to get that up and running. Glencore will come in and provide financing for either ownership stakes in the mine or for royalty and streaming deals into the future, where they'll take a piece of either the production or a percentage of the future revenues of the mine. And obviously, if it goes badly, then they can look at taking it over, a la the CCP model. Anyway, finances third world countries, does all this sort of thing. However, it also has a trading business, so they can't essentially play both sides of the aisle. They're right from the prime producers, they're involved in that, and they can sit back behind a computer screen and trade futures back and forth, both as a hedging tool. So if you own coal and you're producing coal, just as an example, you can move out into next year's on the futures and short the futures production for coal. So if there's a drop in your production, you'll have to sell your coal for a lower price, but you'll offset that by the gain in your short position in your futures. Okay, won't go into that in too much detail. Perhaps that'll be a subject for another day, but they can use that very intelligently to provide hedges to their existing mining operations, and they can use it for outright speculation. Okay, so these guys have their tentacles in absolutely everything around the world. They know what is going on before you do, and they can essentially, through legitimate or otherwise means, they can front run some of the movements in prices and use a lot of leverage to speculate, which is something they've done very well in doing over the past few decades, and made a lot of money just from the trading and speculating business on its own. They're currently in a fantastic position to pivot towards the green revolution. We'll see how that ends up in the future, but if you are looking at the electrification of everything, which is a theme that I believe in, electric vehicles, yes, I think we'll eventually get there. I don't think they're the be-all and end-all, and I don't think things are going to go as smoothly as the mainstream narrative will predict. In any case, I look at it and say, okay, well, how can I profit from this? Okay, that's the Glencore philosophy that's rubbed off on me. And so if you think about an electric vehicle, it requires raw ingredients, okay, raw materials. And who owns them? Glencore. Okay, the main focus at the moment is copper and zinc. They have a huge cobalt site. Problem is, it's in the Democratic Republic of the Congo, so that'll be a little bit of an issue in terms of how they navigate and negotiate their way through that. But if anyone can do it, it is Glencore. They are the ones that are experienced in that wheelhouse. They still have a huge presence in oil and coal, and I believe that there's a bull market for both of those commodities in the future, but they'll have both sides of the aisle covered, with the green metals well and truly is something that they can profit from moving forwards, and they'll still, I believe, make a hell of a lot of money, even if they're not directly involved in oil and coal, because they're not allowed to be seen to be doing that. Don't forget they have the trading house, so they'll know what's going on, and they'll be able to speculate on the prices of those commodities in the future and make a hell of a lot of profit. Okay, let's delve in a little bit deeper. So this company is hugely cash flow positive, with copper at $3.50, and copper at $3.50 is super cheap. At the moment it's trading, I think it closed at $4.23 overnight. Zinc at $1.18. Okay, so the point of that is they're looking to be around about the $7 billion ballpark figure for free cash flow at the end of 2021. And if you look into their statements and the projections, the growth is for the free cash flow is estimated at 20% into 2025. So 20% compounded over the next 5 years is huge from a free cash flow perspective. Their revenues aren't tipped to grow to double digits. They're going to tick along just fine, but their free cash flow is expected to grow at 20%, which is phenomenal. Okay, even if you use a 10% on a free cash flow per share basis, okay, allowing for perhaps some dilution into the future, if they hit a snag, they may need to raise some equity. That's still a very, very healthy margin of safety. So the question is, okay, but how much does that growth cost? And so what's the CAPEX going to look like? Well, if you look, as I have, into the analysis, CAPEX is expected to grow at 3% year on year into 2025. Think about it. In order to extract more from primary products such as mining, you have to spend some money in order to produce the metals or whatever, or the coal or whatever the particular commodity in which you're interested in. In order for that to be mined, you've got to spend some money on being able to pull that out of the ground. And then there's obviously linking with the supply chain, etc. So if your growth is costing you 3% and your growth is going to be 20%, obviously the delta between the two, we'll call it 17% using these numbers. I mean, that's a very, very healthy compounding growth rate in anyone's language. Well positioned for the green revolution, as I mentioned. So they're not just into dirty commodities. They'll supply the raw materials for global electrification theme, which is a humongous theme that I might talk about in a separate video because it deserves that. And coal for energy demands in the meantime. Okay, so they've got their fingers everywhere. Globally diversified and more integrated than, for example, Barrick Gold or Newmont. So I like both of those companies. I like Barrick Gold. I like Newmont. I took an extra position out in Barrick Gold because they have more exposure to copper. And now that I'm sitting back and thinking about it, I've got gold exposure with Kirkland Lake and some of the other miners that I have. Why do I need Barrick when I can have Glencore, which has got everything? But Barrick is just so cheap. Anyway, these are the things that are going through my mind. I'm very bullish on the resource sector. I think that Glencore won't be as sexy and headline material as some of the other companies, but it is the most diversified. It's the most experienced. They are the sharpest sharks in the tank. They have a strong balance sheet, and their focus will be on shoring that up over the next 1 to 2 years. And once they hit their targets, they are going to be concerned with pushing as much capital back to shareholders and being very shareholder friendly during the commodity boom ahead, which is where we start to get very, very interested. Well, I don't know about you. So look at their cash cost per pound for copper, zinc, nickel, and coal. So when you take into account the prices of these particular commodities at the moment, you'll see just how fat their margins are. Okay, so they're making a lot of money, and the higher commodities go, the higher their margins. Let's break down some of their key commodities over the next 3 years. So they've got the copper, their cobalt deposit in Katanga in the DRC, zinc, nickel, ferrochrome, coal, and if you put that into copper ounce equivalents, or kiloton equivalents, then you've got that number down the bottom. Okay, so that's expected to compound at around about 2% year on year for production over the next 3 years. And I'm extremely bullish on most, if not all, of these metals and commodities, particularly copper. So this was my major copper exposure play. We have owned Freeport-McMoRan, which is slightly higher leverage, but it's also more concentrated. So if you look at the annual average expected for these commodities over the next 3 years, like you've got 890 kilo ounces of gold, 51 kilo ounces of platinum, rhodium, oil, vanadium, lead, palladium, and silver. I mean, is there a monster of a company? Okay, here's their capital allocation strategy. Okay, so they're going to keep a strong balance sheet, which is good. We don't want them going too crazy and investing in CAPEX. That's going to be just kept at 3% year on year, which is good. They want to keep their bond ratings high, which is another way of saying they want to keep the balance sheet up to scratch. They're targeting medium-term leverage at the low end of $10 to $16 billion guidance and net debt to adjusted EBITDA closer to 1. So they're going to bring their net debt to EBITDA down by a factor of 1. Okay, it's currently 2.6. Put them in a very, very strong position. From here, they're looking sustainable distribution against fixed payout policy of $1 billion from marketing cash flows plus 25 of industrial attributable free cash flows. So to break that down, everything that's from the industries of their mines, 25% of the free cash flow will be kicked back to shareholders via either buybacks or presumably dividends. And once they hit their net debt to EBITDA. So that should be done by the next year, I would say. They'll be able to bring that net debt down to 1 times the adjusted EBITDA. Additional cash return to shareholders via special distributions or buybacks as sustainable surplus capital. Okay, so depending on the tax laws and what they decide will determine whether they do special distribution, like we got with Royal Mail this year, and buybacks, or whether they do buybacks. Okay, both are good for us. We don't really mind. Depending on your distribution, you'll have a preference for perhaps buybacks over dividends, just purely for tax consideration. Let's look into short term. So next year, we've got free cash flow, EBITDA, and earnings all on a per share basis on the left column. You guys know this. Free cash flow multiples in the middle. Where did I get these from? Industry medians. Okay, and that lines up with the historic median. So that's, I think, is a quite conservative model. I would not be surprised to see these numbers higher. If that comes to fruition, that would suggest an implied price in US dollars. So make sure you convert it back to pound sterling if you're looking at the stock ticker. $9.36, $7.25, and $5.54. If we take an equally weighted average, we would expect a target price of around $7.35 US cents at the end of 2022. So comparing that to where we are now for the price at which we're buying the stock, that's a 50% upside, which is very interesting for the major commodity conglomerate. To be able to buy it at such a price is enticing. Okay, if we look at the EBITDA, we look at the free cash flow and the earnings, and we take a base case, a bull case, and a bear case, and you'll see the growth rates which I've used in here, discounted at 20% because that's the minimum IRR that I want in order to take the risk of investing in capital markets, in individual businesses, and the terminal multiples are extremely conservative, as you can see there. Okay. Probability weighting, so I've given that 60% to a base case, 20% to a bull, 20% to a bear case. I think that that's overly pessimistic given where we are in the macroeconomic cycle. But anyway, no allowances for share reduction. Okay, so we've kept that as is. And so we look at these, we come up with an intrinsic value for each method input, and we have an average intrinsic value suggested at $7.77. So if you knew what that would mean is it's suggesting to us, if our model is correct, based on that, if we want to make 20% year on year compounded on our money, we can afford to pay a maximum of $7.77 for the shares. Okay. Now, we can never be 100% correct in our assertions, and the future is inherently unpredictable, so we apply a margin of safety further. And one way to do that is to simply say, okay, well, what's the intrinsic value of the share, and can I buy that at 2/3 of that value? Okay, so we're getting a 33% margin of safety here if we buy the stock at or below $5.12. So at $4.88, if you believe this, obviously you would look at that and say it seems like this is a bargain stock that's in the buy zone. Okay, obviously everyone will have their different opinions. This is just my opinion and the calculation that I have used, and you know, if you change the assumption, you can change the conclusion completely. So just bear that in mind. It's just my opinion and my projections. Let's look at an IRR basis. Okay, if we look at EBITDA on a per share basis, and we reverse the picture and say, if I pay $4.88, the current stock price, and I get these streams of returns over time and an exit multiple at the end of 10 years, discount those cash flows back at the company's weighted average cost of capital, which is 9%. What would that give me as an IRR? In other words, what would that give me as an interest rate in which I would be receiving on an annualized basis over the 10 years? Okay. In this case, that works out to be 38.86%. Okay. If you take into account the finance and reinvestment rates, it's 23.29, which is very, very good. Okay. Well above our margin of safety, well above the average expected return for an index, which is around about 10% nominally. Same deal with cash flow. We pay the stock price today, we get these expected cash flows and apply a terminal multiple, discount it back at 9% in this case. What's that as an IRR? 32.67%. Phenomenal. Okay, very, very good if you agree with those assumptions. Okay, if you don't, then obviously you need to do your own due diligence. So the verdict for me personally is I have bought Glencore and I will continue to build it up to around 2% assets under management. I would like to buy more, but I just own so many commodity and resource sector stocks that I have to cap the exposure somewhere to the sector. So in summary, it does have a low enough debt. It's got a margin of safety. It's got sales growth, strong margins, free cash flow growth, and share buybacks. So qualitatively, it looks good. And from a value perspective, as an investment, it looks quite good. It's below our estimate of intrinsic value with a pretty decent margin of safety. So it's just my opinion. I'm buying it, and I bought some for the portfolio that I manage. We'll keep track of it and see how it does over time. I think it's set for a huge growth runway, and as long as management does what it says it's going to do, they're going to kick a hell of a lot of that value back to the shareholders. So there we have it. Thanks for watching. If you haven't liked and subscribed, please do so. It means a lot to me and really helps me out. And if you're looking for a value fund or value portfolio in which to invest, you might like to click on the link that I'll put in below, and you can check out the portfolio. You can add funds and hit the copy button if you're ready. If you're not, that's totally fine. You can just add us to a watch list and keep an eye on how the portfolio tracks. So far, we're doing well. The market is selling off, and we are holding our ground and outperforming some of the other managers. So very happy sticking with the process. This is the process. So if it makes sense, obviously make sure you check it out. Otherwise, if you just like watching for entertainment and educational purposes, totally cool. Add us to a watch list and make sure you keep up with the latest videos. Disclaimer, got to be responsible. I'm not your financial advisor. None of this is advice. It's just my thoughts and opinions and what I'm doing with the funds that I manage. So make sure you are responsible, take responsibility for your own decisions, and do your own due diligence. Thanks for watching. Having said that, I wish you all the best, and I'll see you in another video soon.